Have you ever wanted to know exactly what a safe growth annuity is? Well, in today's video, I'll give you all the answers so that you can know whether or not you might want to place one into your portfolio. Hi, I'm Charles Cannon, certified financial planner and founder of the Lifetime Income for You channel. Click below to take my Masterclass and apply to become a client. And inside that Masterclass, I make 3 great offers for retirement planning tools for my clients that allow you to live your best retirement. So do it today. In the past few weeks, we've talked about why annuities are safe and how income annuities work. And in today's video, we're going to talk about how safe growth annuities work and help optimize your portfolio. When you make a deposit in an insurance company in a safe growth annuity, the guarantee you're going to get is that you cannot lose a penny. But the upside is much greater than especially the bond portion of your portfolio might be able to provide you. Now, of course, it's not going to do as well as being in the S&P 500 every year for 20 years, but it's never going to take a negative, and it's going to help balance out the portfolio so that your 60-40 split or 50-50 split between stocks and bonds instead becomes a 50-50 split between stocks and a safe growth annuity. And that will optimize your overall return and provide more safety than the bond portion of your portfolio might. Who might use a fixed indexed annuity? Well, first, you should have most of your base income needs already covered by something that's guaranteed. Social Security is a part of that, and also a lifetime income annuity is a part of that. Beyond that, if about half of your assets were taken off the risk spectrum and placed into a fixed indexed annuity, that would optimize your portfolio, because a fixed indexed annuity can never lose a penny, and most of them have no fees whatsoever. How do they work? Well, you're going to pick the underlying index that is used inside your annuity. And when that index goes up every year, you're then going to get a portion of that interest. Basically, what we're looking for is to get about 50 to 55% of the upside of the S&P 500, but none of the downside risk. So if from year to year the S&P is negative, you will not lose any money inside your fixed index annuity. And when it goes up 8, 10, 12, 15%, you're going to get about half that amount credited. Over a decade or so, the very best safe growth annuities have averaged somewhere between 5% in a really bad decade, up to almost 9.5% in a really good decade. But for planning purposes, you should not buy a safe growth annuity unless you're going to be happy with something at the low end of that spectrum, somewhere between 4.5%, 5%, 5.5%, maybe 6%. One of the nice things about these kinds of annuities is you can never lose principal and you can never lose interest that has been credited in the past. So it allows you to have a portfolio that you don't have to worry about every day. Also, as I explained a few weeks ago, these contracts are usually no fee. The insurance company makes their money off the spread, which means your money is not invested in the stock market. It's inside the insurance company's bond portfolio where it's safe. And at the end of the year, when the insurance company makes 5 or 5.5% off that portfolio, basically they keep about half of that for themselves, and the other half is what they credit you or actually use to buy the underlying option for your index. Just think, if you're an insurance company and you've got a $40 billion bond portfolio, 2.5% or so is a pretty good profit margin. That's why insurance companies are so safe, because they're not out there investing in hedge funds and things like that, trying to hit home runs. They're hitting single after single after single, and that's why they always stay profitable. Like I said, the insurance company is going to take the 2.5% or 3% that they would offer you in a fixed rate, and they're going to buy you an option in an underlying index. And usually what you're going to get is what's called the participation rate. So right now, because the S&P has been so dramatically up and down this year, S&P 500 options are very expensive. So if you look at a contract right now, you might only get 25% participation in the S&P 500. That's pretty low. But most insurance companies have built their own, what they call smart indexes, that will be a mix of S&P 500 and government bonds. And the participation rates might be 70, 80, maybe even 100% or more, which allows you to end up with an amount that would likely be around 50% of the S&P in a good year. And remember, when the market goes up, you're going to get that 70 or 80% of that underlying index's gain. But if that index goes down, you don't lose even a penny. The way I like to use Safe-Growth Annuities is replace the bond portion of someone's portfolio. You've heard the classic 60-40 split between stocks and bonds. Well, if we took that 40% and instead put it into a fixed indexed annuity, over time you would have a greater yield and it's safer. Market expert Roger Ibbotson wrote a great white paper on this topic. And if you sign up below to take my Masterclass and apply to become a client, I will give you a copy of his white paper as one of my 3 free gifts. If you would like to add an annuity to your portfolio to optimize it, click below to take that class and apply to become a client. I'm Charles Cannon, and remember, the most important part of your retirement is lifetime income for you.